In today's video, we're going to go over what is liability driven investment, known as LDI, and were the UK pension funds about to go bust on these LDI. Hi everyone, it's Daniel here from InfoVest, hoping to keep you updated on the markets and the news. Now, if you find this video resourceful and helpful, please give a like to this video, hit the bell icon, and subscribe to be notified on the next videos that are coming up, and feel free to comment and share this video with your friends and family. Okay, so what is liability driven investment, known as LDI? Well, the definition from Bloomberg basically states it's a strategy used by pension funds to manage their assets to ensure they can meet future liabilities, thus the name. The trades are typically used by so-called defined benefit pension plans, which guarantee retirees a certain payout regardless of the swings in the financial market. Okay, so what does this mean in plain English? How does the LDI strategy really work? Well, to put it simply, the LDI strategy is there to estimate the future cash flow that a retiree will need. Now, this future cash flow, this income that the retiree will need, is basically a liability for the pension fund. So the pension fund takes the retiree's portfolio, invests it in the markets so that down the road they can manage the liabilities and pay the retiree the income that was expected in the future. So now we'll go more deeper in this LDI strategy. So you have two areas of the portfolio. One is the asset and the other is the liability. Now, for this strategy to work, both asset and liabilities are moving either up or down together depending on the interest rates, yields, and market volatility. And they do this so that the pension funds can either pay their liabilities to the retiree and possibly earn a return as well. So if your liabilities are going up, your assets should also go up as well. And if your liabilities are coming down, it will match it with the assets, and the assets come down so that they're in tandem together and they're not affected by too much of the market volatility. So according to this strategy, when interest rates are going up, you have the assets and the liabilities basically coming down. Now, this is a problem because one of these, either the assets or liabilities, one of these may go lower than the other. They're never equal to each other. So it's possible that liabilities may go more than the assets, or the assets may go more than the liability. And generally, you want your assets to be higher than the liabilities and not vice versa. So always you're looking to seek assets are greater than the liabilities and not assets are less than your liability. Now, if this happens, if let's say the assets are less than the liabilities, this scenario here, then it's the job of the portfolio manager to restructure the portfolio in such a way that fixes this issue. Now, let's relate this to today's problem. Pension funds almost went bust from this strategy because a lot of them had assets in these UK gilts, which are basically long dated bonds. That's what UK gilts are. And as we know, UK gilts have been dropping in price since interest rates have been going up and inflation has been elevated. So for those who don't know, there's an inverse correlation between the price of the bond and their yields. When interest rates are going up, the yields are going up, inflation is going up, UK gilt yields are going up, and the UK gilt prices are falling. And when these yields rise, it has this inverse correlation that causes the value of these UK gilts to continue to drop in value. Now, these pension schemes hold about 1.5 trillion pounds in assets, and about 50% of these are in the UK gilts. Now, if you can imagine, if these assets are dropping in value faster than the liabilities, you have that scenario like I showed you before, assets less than the liabilities. And if this asset part, again, dropping more than the liabilities, you have an issue with the pension funds, and then it leads to something that is called a margin call. So what is this margin call, right? What happens there and what does that mean? So a margin call for a pension fund, and a pension fund that's managing a lot of money, would basically mean that they would have to sell their assets. And remember, the assets that they own are the UK gilt. So they have to sell the UK gilts, which is causing the price of the UK gilts to drop even more and causing those yields to go up. And when that happens, guess what? You have other pension funds also invested their assets into those same UK gilts. So if one pension fund does it, then the second pension fund will see that, okay, the yields are going up, so they're going to get margin called also. And it's a trickle effect, a domino effect that will just spiral into this big snowball that will cause yields on the long end to just skyrocket, UK gilts to just drop like no tomorrow, and lead to this 2008 Lehman Brothers situation, or this bust, where all these pension funds are just going bankrupt because of the margin calls. Now, what makes the scheme even worse is that the pension funds are at a risk of interest rates. And what the pension funds have done previously is they got into a interest rate swap. And they did that long ago to hedge against from interest rates rising. Now the problem is, and let me explain a little bit about this interest rate swap actually. This interest rate swap, what it is the pension funds basically got into this deal with a bank or some other party, and they end up paying a variable rate and they receive cash flow in a fixed rate in a swap scenario, because their views were that interest rates would continue to drop and continue to drop. So they would basically get paid a fixed rate, which is a high rate, the higher rate, and the variable rate, because rates are expected to come down lower, they would be paying less while earning more. Again, comes down to that assets versus liabilities. Their assets are higher than their liabilities, all is fine. Now that may have worked previously until now this situation where we have all-time high inflation and all the central banks around the world are increasing interest rates to levels that we've never seen, or have seen, but levels at a fast rate that we haven't seen, the rates that we haven't seen in a very long time, since 1980s. And they're doing this all to combat inflation and bring it down. Now, when you start increasing those rates at a very fast pace, again, you're affecting the yields. Again, the interest rate swap means that you are paying in a variable rate. So if you're paying this variable rate, basically your payments, your liabilities are now going up because you're now paying more because rates are moving higher, and your cash flow that you're receiving, your assets, is fixed. So that's not changing. And again, you get the whole scenario, the assets versus liabilities, where the assets are not growing as much as the liabilities. And since the liabilities are growing quite substantially and the assets are not, you get this margin call scenario where the pension funds are now margin called and they have to sell their assets, which are the UK gilts, in order to cover their liabilities. Now it's September 30th, 2022 today, and things didn't blow up yet, and that's okay. And there's a reason why that didn't happen. It's because the Bank of England, the central bank of the UK, stepped in and decided to do something called quantitative easing, or they may not call it that. They may call it something else, but you can, same words that the Fed said back in before the COVID crash happened, non-QE, QE, back in 2019. So same thing here. The Bank of England is doing the same thing, where they're going in and they intervened by purchasing these UK gilts to help the pension funds so they don't go bust, so that the banks that they're dealing with and the insurance companies and the whole financial industry just doesn't blow up. right? So the Bank of England came in and basically started this bond buying program right away. And it's funny because they initially were doing QT, which is tightening, and they had a plan to discuss about the balance sheet runoff. And as soon as this problem came and hit, they flipped 360, went from tightening to now easing and buying these bonds so that they can bring those yields on the long end, the UK gilts, those yields down. And when that happened, the UK gilts yields basically dropped 100 basis points to help these UK pension funds and the whole financial industry, so that you don't have that big chaos blow up like back in 2008. Now, what does this mean going forward, right? We're in the year 2022. We're heading into 2023 within the next 3-4 months from now. Could this mean that there are signs of an ugly recession to come? And I think the odds do look like something is cracking. There's cracks starting to show within the financial system, and we're seeing it from the UK. And this can exacerbate globally because you do have a lot of companies who do utilize the LDI schemes around the world. A lot of countries out there that do that. And BlackRock is one company that comes to mind, that is a US-based asset management company managing trillions of dollars. If they have an effect because of the LDIs, which they are participating in, definitely you could see some very, very bad signs to come down the road in the markets and in the economy. So definitely the cracks are showing. It doesn't look good here, and things could escalate. Now, again, I'm not really giving, I'm not giving any financial advice here. I'm not saying that, sell everything and get out. I don't know what's going to happen down the road. But definitely when I hear signs like this, where a central bank needs to come and intervene, because if they don't, something's going to blow up, then definitely, that's not a good sign. And the question is, how long will this last for? Will they continue to buy bonds? I think not. Eventually, they need to fight inflation, because when you buy bonds and start easing, that doesn't solve the inflation problem that the whole world is facing. And there's so many geopolitical issues down the road that we could see, that I could get into maybe in another video, that definitely puts the UK and Europe into a very, very big situation. A very, very negative situation down the road. So we'll see what happens. Definitely the odds of seeing some sort of recession, or maybe something close to a 2008 type of sell-off in the markets, the odds are looking higher and higher. But again, we'll have to monitor the situation. If the Bank of England stops easing because they need to tighten harder to fight inflation, then sure, we could see those yields pick back up again. And then if pension funds are not ready, or the system is not ready, then sure, something could blow up, something could bust. And it's very interesting to see also BlackRock CEO come out a couple of months before this happened and sell his shares at a level that he'd never sold before, back before the COVID crash happened. And he's doing the same thing, or he did the same thing just previously a couple months ago. So let's see what happens. So if you enjoyed this video, then please give a like to this video, subscribe, hit the bell icon for future notifications, leave a comment as well, share this video with your friends and family, and I hope to see you guys around. Thanks. Cheers.